Hello and welcome to Bank of America, 45% in 9 days. Let's go look at the numbers. All right, here we are. So Bank of America got in on the 3rd and it got out today on the 11th. We got in at 72 cents. We got out at $1.05. And for those who are new to options, that means it's per share, and in one contract is 100 shares. So let's do the numbers. 105 times 100, it's 105 minus 72, which would be the $72. We had a profit of $33. Divide that by the cost of 72 as a percentage, and the return was 45.8. So 45.8% return in 9 days. All right, so let's go to the chart, and we had 6 contracts, so let's bring that back up again. So we had 6 contracts, $33 times 6 came out to $198 return, minus $8 approximately in fee. Excuse me. And we had a net win on this trade of $190. All right, chart time. Let's go look at that chart. The trade was set up here on this candle here, and it was on this was February 1st. The trade did not trigger on the 2nd. Why? Because it did not break my entry number at 47.2, and then it did get triggered here on slippage, and then finally it broke out and went up, rising up, and taking off from there. We hit here. This close was over the 100 ROI with 145 ROI on the 8th, and that is the 8th. That's 145. So our ROI 100% plus rule was initiated, which is a last bar low. But there was a slight change this weekend, and I met a mentor called KappaMan, and we talked about some things, and we used the RSI. If RSI stays above the 40, it stays above the 60 line, that we were ready to trade out. So I did that, and then what you do is you look for what they call a dipper low exit. And here's the dip from the high to the low to the high. The lowest low of the candle becomes a stop. That's what this red line is. So I'm going to explain the lines because I got requests from some of my fellow traders in the other discussion groups, and they were interested in knowing more about the line. And now, for some reason, my grabber is not where it is. It's working now. Okay, we'll get into the notes after we get past the mechanicals here. So this is the 3-to-1 ratio ruler. And in my prior videos, I showed how to set that up. And you want access to try to do it on your own. If you right-click on your wheel of your mouse, come down here to the retracement. Which one is it? It's that one, I think. Maybe. Let's see. Fibonacci. There it is. Nope. Fibonacci extension. You click on this one here, and then that will give you the Fibonacci. Then you go in and you have to go ahead and adjust that. I'm not going to go into that because we're running on the clock here. I like to try to keep the videos under 10 minutes, make it quick and easy, and quick and fast to get this. And you're invited to pause the videos and look at in deeper on your own. So what happened was we got our dipper low, and then we got stopped out here on the open, and that open resulted in a 45% return as opposed to the 145 we're looking at this possibility. What else? This here is the deviation, the standard deviation, which is created through what's called regression channel. Again, you on your mouse, click there, and you come down here, and there is the channel regression right there. Then you open this up, and then you can add your deviation. This is standard deviation of 1, 2, and 3. So this is -1, -2, -3. This is -+1, +2, +3. the anticipation is that price will bounce between these tracks as it climbs up until the trend bends in the end. Other lines here is the 30-day moving average, which I use as a judgment of price action. The more the price breaks away from the 30-day moving action, the more opportunity, the more momentum that it has. And that's another explanation of the 30-day moving average. So that explains, and then we have price channel. These are my price channel. This is my inner price channel and my outer. This is my 55-day and my 5-day. And I use those to gauge where price might be one extreme to the other, very similar to the standard deviation. Standard deviation, except that it's based on the price channel, also known as the home base, is known as the Dodging channel. You can go and there's lots of videos on explaining it. So let's go ahead and do the numbers here. Oh, this cross one here. This is the horizontal, my 3-to-1 ratio. This is my anticipation target that I would like to get. This is the median price on this angle of attack of the price action. And that's the anticipation of where we expect price to be able to cross, which would be on the expiration date of 18, which won't happen because we already exited the trade here. So going on to the numbers, this was CB, channel breakout. A 3-to-1 ratio was our target. We are in this 95 is stochastics, that's RSI, that's the number of volume. 6 contracts and a call, date to expiration 18 February, delta 32. This was a low delta. And the dangers with low delta is volatility. You can get stopped out and have a tremendous loss. I had a loss on one trade that was 88% on the option, but it was one trade out of 10. The other two or three trades at that time period came in over 200 plus ROIs. They made up for the 80%. But the lower delta gives you opportunity for more contracts. And if you're going to be a target shooter, say, you know what, I want X number of dollars, then you can go ahead and say, okay, how many contracts will take to get to that target? Going on with the numbers here, this was the estimated, we were estimating to get filled at 65 cents, and we got AOC stands for actual option cost, and we actually got filled at 72 cents. And then the allo is allocation at 8.8. That's to remind me not to over allocate. I lost $500 on a trade because I over allocated, not paying attention. Going down this is the target that we're looking for on the options to recover the 1531, which we know it wasn't going to happen, but at least a little something toward the contribution. Last bar low exit is the initiation down here. Last bar low exit there. And then we had that dipper low, which occurred. We had a dipper low, and that's what the dipper low is there, and that's the exit. And then coming down to the finals is we exited at 45.89 days, $33, 6 contracts, $198, $8 in fees, $190 for the return on the profit against 1531 owed, giving us a new owe now of 1341. And that is the conclusion of Bank of America. Now we're going to go and do a video on a loser with Carnival Cruises, and we'll explain the various lines and features that I have here on chart again. So it's not, so it becomes a little more understandable and to you guys. Okay, well, that does conclude the report, and I thank you very much. If you think this was of any value, please give me a like. I would like to see those add up there, and I thank you very much. Tell your friends that options are not difficult. They can be a moneymaker, but you got to know what you're doing. With that said, take care. Bye-bye.